following is a Silver Bullion television audiocast. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Our guest today is Craig Hemke, editor and publisher of the TF Metals Report, a well-known website in the precious metals space where he provides his analysis of the economy and precious metals. Craig, thanks for joining us again on SBTV. How are you doing?
Patrick, it's always great to visit with you, and I'm just doing great. I think we're going to have quite a fun couple of years here in gold and silver.
That's great. I think we need it. Everything's been kind of flat and sideways for a while.
Yeah, no doubt about it. It has been a long, it's been almost 6 years now since price was smashed down through 1525 and fell all the way to 1320, and now here we are 6 years later at 1320. So yeah, I'm ready for some fun.
Okay, cool. Hey, Craig, let's start with the strong dollar. 2018, we saw a dominant dollar, which in part probably dragged gold and silver prices lower. Despite that, gold did end the year with only a 2% drop. What do you think of the performance of gold and silver last year?
Yeah, last year was, an interesting year to say the least. I thought we had a pretty good handle on it at my site, the TF Metals Report, in that we thought by the end of the year, we'd be pushing 1,400 instead of 1,300. And that was based upon the idea that by the fourth quarter, everybody would be figuring out that the U.S. economy was slowing and that the Fed policy would be reversing and that the political stagnation, talks of impeachment and all that kind of stuff would be killing business and consumer confidence. And I thought that would have led us to 1,400. Instead, we got smashed so badly through the summer that it set us back so far that we only made it back to 1,300. So I think we're on track for where this is all headed, but we're maybe $100 behind schedule. The fact that we did recover, though, a lot of folks try to say that was all due to safe haven buying as the stock market was collapsing in December, and I would say I maybe a little. I think, though, it's more of a secondary concern in that, money was flowing into the bond market because of the stock market collapse, and lower interest rates are good for gold. And so that kind of spilled over kind of secondarily. And I think even more important, people began to realize globally, beginning in late November into December, that this notion that the Fed was going to hike rates 3 or 4 times in 2019 was ridiculous. I mean, I even saw, Patrick, back about November the 10th or 12th, that lead economist of Goldman, that Jan Hatzius guy, was still talking about 3 or 4 hikes this year. Yeah, that's what the prevailing thought was. And now here we are. I don't think anybody's expecting any hikes. Maybe they'll still come up with one in March, but that's it. And so gold really caught a bit and continues to move higher based on this. It's the world figuring out that the Fed is moving back toward rate cuts and even QE.
A couple of those things you mentioned, hey, they're still in play. I mean, whether it's the Fed slowing down or whether it's talks of impeachment, all of these things they're still in play. So 2019. I think we're going to find out a lot of things by Q2. But getting back to the strong dollar, do you think it'll remain strong in 2019, or do you think these factors and some other factors will sort of weaken it a bit?
Yeah, I would think that's exactly what's going to happen. The hardest part about forecasting the dollar, Patrick, is we always refer to it as the dollar index. That where the dollar is compared to this basket of other currencies. It's primarily the euro. But it's also looking at the yen and the pound and and all these other fiat currency. And so sometimes the dollar rises because it's that old metaphor of the cleanest shirt in the laundry, that kind of thing.
Right.
And so you look at it and you think, why is the dollar going up today? And people will ascribe all these reasons to it when really it's because the euro is going down on that particular day. And so that's what's always challenging about predicting the dollars, because there's all these other cross currents from these other fiat. Go back to 2013, the U.S. had just announced $1 trillion in QE3, and everybody thought, including myself, oh, that's going to be bad for the dollar. But it was perceived, the other central banks, the Bank of Japan and the ECB, were printing so much yen and euro that they were actually weaker and the dollar went up, regardless of the $1 trillion in QE. So sometimes it's very difficult, obviously, to predict the dollar. But I will say this. This time around, the people aren't going to fall for the idea that the Fed has it under control, or that QE and all this other stuff was a one-off. I even saw somebody a lady on CNBC as like a money manager last Wednesday when Powell had his latest FOMC and press conference. Mm-hmm. And this lady said, what we all have seemed to have forgotten is that we are still in the midst of a huge monetary experiment. And that's exactly right. I mean, everything changed 10 years ago. This is still, the Fed flying by the seat of their pants. And I think as more people come back to that reality, it's bad for the dollar. So that would be, I guess, ultimately where the dollar heads.
Yeah, I hear you. Predicting the dollar can be, pretty difficult. But given the situation with the U.S. economy at this moment, do you think a stronger or weaker dollar is more beneficial for the economy?
Well, there's another paradox you just pointed out, right? As the Fed was raising interest rates, you kept getting this bid for the dollar for a number of different reasons, making the dollar stronger. And the Keynesian school always says, well, a strong national currency is bad for your exports, and thus slows your economy. And so there was kind of a paradox there, of what was going on. So in that traditional sense, you'd think you'd want a weaker currency all the time to make it more competitive on the global stage, right? But again, then it flip-flops, right? Because if your currency is weaker, that just means somebody else's is stronger. And one more thing that gets factored in is with all the emerging markets that hold dollar-denominated debt, when the dollar rises, it really, really hurts emerging market currencies. And that tends to fester across the global markets too. And so there are, a number of, I guess we'll call it contrary or factors that are kind of washing back and forth that make it really difficult to try to manage all of this for these monetary officials. And I think at the end of the day, though, the biggest lesson in all of this was that higher interest rates just simply cannot be tolerated. And I think by now most folks have seen, if you plot the global central bank balance sheets with the global stock market indices, you see they move almost on a one-for-one basis since 2009. And we kind of reached a breaking point in 2018, where as soon as the Fed started talking about tightening and withdrawing liquidity, the market began to crash. And so I think that's going to be a real theme here this year, is that the Fed has figured out, well, what's the lesser of two evils here? Right. We have to keep printing if we're going to keep everything afloat, because so much depends on the stock market here in the U.S., pension funds, everybody's retirement plans, 401k, all that kind of stuff, that they'll choose to reflate and print money, dollar be damned, just because they'd rather deal with whatever those consequences are rather than the near-term consequences of a crashing stock market.
The 2010 mirror, you recently wrote that the rallies in 2010 and 2011 they're presenting themselves again in 2019, and that 2019, right. Yeah, it could very well mirror the price gains of 2010. Can you take us through how you arrived at that conclusion?
Yeah, you've probably heard the idea, or the old adage about history doesn't repeat, but it rhymes, right?
Yes.
And that's what dawned on me. When I first started this site was November of 2010. And so the metals became my sole focus in 2009. And so I was, this is something I was paying attention to. And so it's like deja vu, right? Where something happens and you go, wait a second, I kind of remember this happening before. That dawned on me last year in that, this feels a lot like, this looks a lot like 2009 and 2010. And so now let me rattle off some stuff to tell you how it is like 2010. You remember back then, coming out of the great financial crisis, you couldn't turn on Bloomberg or CNBC without having somebody mention the term green shoots. Remember that one, Patrick?
Yes.
It was as if, economy was rising from the ashes, and these green shoots were emerging, like after the forest fire. And I guess to some extent it was true that the second quarter 2010 U.S. GDP was north of 3%. Okay, and everybody thought, oh, okay, great. QE was a one-off. This debt monetization of $600 billion. It was just a one-time thing the Fed had to do in March of 2009 to kind of get things rolling again. That was never going to happen. Rates were going to normalize. It was all this stuff that you're currently being told now. That, all of that was a one-off, and the economy now is better, and the Fed's going to normalize. It's exactly what we were being told in 2010. And in 2010, the year began with gold at 1050 and silver at about 16. And by the middle of 2010, gold had begun to rally, but silver was still 16. And then the economy began to slow. And the third quarter was 2%. The fourth quarter was a little more than 1%. And in November of 2010, the Fed began QE2. And that was when the dollar really, began to slide. Gold then finished 2010 with a 30% gain, up near 1,400, on its way to 1,900 in 2011. And it was that onset of QE2 that took silver from 18 in the summer of 2010 to 48 8 months later.
Yeah.
And so, again, here we are. The economy's slowing. The Fed's reversing policy. It's not a one-off. This, again, it's not exactly what we had in 2010, but it's pretty dang close. And I think the world will, the investing world will begin to turn their focus again to precious metals as they begin to realize this, and this is what we're already seeing.
Let me play a little bit of a devil's advocate here regarding 2010. The 2010 price gains came on the back of the economic damage from the 2008 financial crisis and the pending announcement of QE2, both of which we have yet to see at this moment. There's no indication of any QE at this moment. Wouldn't it that both these catalysts contributed significantly to the 2010 price gains also, or do you think that they have limited impact?
Well, I think, again, I think where we are this time in 2019 is like where we were this time in 2010. Yeah, there was no indication of QE2 in January of 2010, just like there's no indication really of QE4 in January, February of 2019. I'm just looking over the horizon. The economy is slowing the same way. The liquidity is needed the same way. All those things. Yeah. And I would also put this, and this is something to think about. There was a rush to physical metal in 2010-11, really for the first time, because people, some people at least, recognized that this was something completely different. And we were all reading books about the Weimar Republic, and all this stuff, and runaway hyperinflation from all this money printing. And clearly that didn't happen because so much of that cash that was printed was held in the reserves of the big banks, the excess reserves. We never got the velocity of money and everything else that that people thought with the recovery, and so a lot of that demand and excitement never really panned out. But at the end of the day, owning physical metal and the move of the price of physical metal is ultimately about a loss of confidence in the currency and the value of the currency going forward. And coming out of QE3, people kind of regained maybe a little bit of confidence in the dollar, or that the Fed, was, finally everything was kind of normalized. They started talking about tapering, and then they started talking about cutting everything off, and then they started talking about hiking. And you've had this kind of confidence generating, building scheme for the last several years. But if we revert now back to just cutting rates, and again, maybe by a year from now, whatever, more QE, that confidence is going to evaporate. And that's going to, again, for maybe the somewhat same set of circumstances, lead to higher metal prices.
Yeah, every time I hear the Fed talk about tapering, it reminds me when I used to work in construction, and we had the drywall guys come in and they'd put the tape all over the cracks and the joints and everything else. And that, to me, every time someone says taper, that's what I think of.
That's a good one.
Yeah. Craig, do you expect any announcement of QE by the Fed this year?
Well, that was one interesting thing of several that Powell discussed during his press conference last week, because there was a question from a guy about maybe 10 minutes in. I can't remember who it was. and he said, normally, the Fed might start cutting Fed funds rates from north of 3%, and here you've only gotten to 2.5%. Is this unusual? How will that affect policy? And Powell predictably went to the line he's used before about we will have the next time there's a downturn, we have every tool in the toolbox at our disposal. He said that on countless occasions.
Yeah.
This time, though, he tagged on that something, and I can't remember exactly his direct words a week later, but it was something to the effect of the balance sheet has the room to grow substantially higher, is how he said it. So they're telling you that regardless of how much quantitative tightening they do or whatever, if they need to turn around and restart QE and take it even, their balance sheet to a whole new level from where they peaked out last time, they're willing to do it. So it's, in some ways, because really the crisis never ended, and liquidity is so important now. In some ways, I don't see how that's avoidable.
Yeah, I hear you. But for the Fed to start cutting rates again, do you think there will need to be some sort of panic in the markets before the Fed sees it necessary to pump liquidity again, or do you expect this panic to come from the stock markets?
Or the economy in general too, Patrick. It was about a year ago right now. I remember it was right after Super Bowl Sunday. I was sitting I always go to Vegas for the Super Bowl, which is great fun. And I was sitting in the Vegas airport flying home the day after Super Bowl Sunday, and the stock market was just crashing. And at the time, people, that were noticing the connection saw that the 10-year note got to 2.9%. And once it got to that level, it was like a magic bullet. It just killed the stock market. It crashed about 10% all the way down to its 200-day moving average, and there's panic everywhere and all this kind of stuff. Then it came back up, and the 10-year note got back to 2.9%, and it crashed again about a month later. Well, we finally handled 2.9, but last fall we got to 3.25, and in October we crashed. And then the bond market sold off again, and we got up to 3.24 on about November the 10th or something like that, early November. And I remember putting something on Twitter that said, hey, the last time we got to 3.25, the stock market crashed. So if you're in the stock market, you better be careful. And lo and behold, the next day, and again, it's not like I'm Nostradamus or something. It was just like, the last time we got to 3.25, down it went. And then that selling carried us all the way through to Christmas. And so it seemed to be that there is definitely a connection between, anything up around 3% and the stock market just unable to take it. And so that's got to factor in as well. And I'll give you one more thing, Patrick, that, again, this is going to impact the Fed. The current Fed funds rate is pegged at 2.25 to 2.5. They never give you like a straight number. It's always that 25 basis point range. And so when you see it printed, a lot of people will say 240. Well, in the aftermath of Powell last week, the 2-year note, the yield on the 2-year note fell to 240. And so if the 2-year note doesn't go up to 280, and it's about, 250 as we speak here this morning, if it doesn't get back up to 280, then a 25 basis point rate hike in March is going to invert the curve, if you want to call it that, from Fed funds to 2 years. Well, they're not going to do that. There's no way they're going to do that. And so I would encourage people to watch that. Even the 10-year note is at 270.
Yes.
So if you go now to your next rate hike is 250 to 275, and so everybody calls it 265 versus a 10-year note at 265, they're not going to do it. The stock market weakness is important, liquidity is important, but at the same time, the rest of the curve is important too in predicting what they're going to do next.
You wrote about the 1 full year of COMEX EFPs and how astounding the total amount of gold allegedly exchanged for physical over a period of 12 months. For our listeners who may not be familiar with the exchange of futures for physical or EFP, can you explain how it works?
No, I wish I could. I can't find anybody that can. I mean, I've been trying to get these answers now for over a year to get somebody to explain to me, what the heck is going on here? Because every single day, Patrick, you see, I don't know, 10,000 contracts, sometimes as many as 20,000 contracts, COMEX contracts, okay? So 10,000 contracts at 100 ounces per, we're talking, what is that, 1 million ounces that are allegedly exchanged for physical. Now, that could be physical metal. That could exchange for some other forward contract. Sometimes they say they could be used for GLD shares, or whatever. I have no idea. And I started keeping track of this in late November of 2017. And in the first 12 months of keeping track of it, the total amount of COMEX contracts that were taken off the exchange just by monitoring it every single day. And then in this exchange for physical, and if you could see me, I'm making like the little quotation marks with my fingers.
Yes. Yeah.
And the only way it could happen is in London, because they don't have the facility to do this, in Hong Kong or any place like that. The total amount was nearly 8,000 metric tons of gold.
Right.
Now, the entire vault of the LBMA is about 7,800 metric tons, and that includes all of the Bank of England's gold. That includes all of the gold that's allegedly held in the ETFs, the gold ETFs. And what is not listed just for that is like 800 tons. So there's 800 tons that's owned by other central banks and stuff like that, and yet this process of this exchange for physical is 8,000 metric tons in a year. Well, what the hell are they actually exchanging? So, again, and I can't find, it is so opaque, and that's how the LBMA is structured anyway. Nobody can explain it. Nobody knows, but they keep posting these numbers, so something's going on. If anything, Patrick, it's emblematic of what an utter sham the pricing scheme is, because the whole scheme relies upon that stuff.
I'll skip my next question, which is, are there any physical movements of gold between warehouses when the exchange of futures for physical happens?
Not that we can tell. I mean, you don't get any of that. This is apparently taking place in London, and they don't print any kind of stuff like that. Andrew Maguire told me once that in the LBMA, in their vaults, these different banks, they have like a blue line on the floor of the vault. And on one side of the blue line is like allocated, and the other side is unallocated. And they just, forklifts come in and they just move it from one side to the other. Now that would be physical movement, I guess. And a lot of it is just promissory notes, and forward contracts and, other paper promises. But if anything, what this should tell people is what a scam this whole process, this pricing scheme is, because it's not based on, here's my ounce of gold, you're going to now pay me some, fiat money for it. They've alchemized it. They've turned, a little pile of physical gold into this massive pile of gold derivatives. And it's the trading of all these derivatives that then establishes the price, as if the derivative is as good as the real thing, which many people accept it to be, but sometime, eventually, people aren't going to accept it to be. And once that happens and the music stops and everybody that thinks they own gold finds out that they own, no, you own an unallocated account, that's what you signed up for back in the day, and I'm sorry, we don't have it, so you're just, SOL. Well, that's when it gets crazy.
Yeah, you better be friends with that forklift driver in the vault to move your gold over to the other side of the line, huh?
Yeah. Well, that's what your company does. That's what, and so many other reputable companies do, where you can buy physical metal, the actual thing, not the GLD scam, not the, some unallocated account in Australia, this kind of thing. Buy the physical metal and store it with a reputable, honest place, or store it in your own vault. That's the only way you can be certain that you own physical gold or physical silver. And while the system maintains itself, okay, fine. Then, play with your GLD and et cetera. But boy, when it finally comes that people figure out what a scam this whole thing is, and what an illusion it all is about how much, real physical metal there is, that's when those playing the paper games are going to get smashed. And I'll add one more thing, Patrick. Another thing that it shows you why this is all, how screwed up this all is the gold-silver ratio.
Oh, boy.
I mean, for as long as you go back in time, it's either 9-to-1 or 16-to-1 based upon how much physical gold there is in the world or what comes out of the ground versus physical silver. Well, we don't price it that way anymore. We don't price it off of physical. We price it off of these derivatives, and now it's 85-to-1. I mean, if anything tells you or tells the regular person about what a fraud the system is and how the system is based upon this mountain of derivatives, not real thing, it's that gold-silver ratio.
What do you think it's going to be that will be the likely scenario for this house of cards to fall?
I'm going to give you one thing right now that people need to watch, and that's palladium. You may have seen palladium price. Palladium prices are up 70% in the last 5 months.
Outstanding, yes.
Okay? New all-time highs. And every traditional signal that we have shows that it is an extreme physical shortage. The lease rates from one bank to another in London, if you want to borrow physical because you're on the hook to somebody demanding physical delivery from a promise you previously made, your lease rate is 20%. Okay, that's like Shylock level rates. The futures board in New York is in full backwardation from spot all the way out to the farthest futures contract, which is March 2020. The backwardation is about $110. Those two things right there, clear traditional signs of extreme physical shortage. If that's the case, the COMEX Palladium market is structured identically to the gold and silver markets in that there are about, the open interest in COMEX Palladium is, let's call it 28,000 contracts. So that's meant to represent 100 palladium ounces per contract. So the total open interest is about 2.8 million ounces. Okay? If you look at it that way, you with me?
Mm-hmm.
How much palladium do you think is in the COMEX vaults? Total. I'll help you. I don't even want to make you guess. 42,000 ounces.
That's it?
So there's digital obligations for 2.8 million ounces. There's 42, and I'm not talking just registered palladium. There's 15,000 registered palladium ounces. There's 27,000 eligible. The entire vault is 42,000. And the amount of make-believe palladium that trades there is 2.8 million ounces. So if London really is out, and that's what the lease rates and the backwardation is telling you, and if the only remaining stockpile is in New York where the leverage is 70-to-1, that whole market could completely collapse. And how long will it then take, at least I'm hoping, for a new set of, let's call them metal vigilantes, not the bond vigilantes, but the metal vigilantes to go, well, wait a second, time out. If the palladium market just completely evaporated, are the gold and silver markets structured the same way?
Yeah.
So I'd say watch palladium very closely. We used to talk about silver being the Achilles heel to the system. Palladium may actually be the Achilles heel.
Yeah, I don't think palladium was on anybody's radar to be the Achilles heel. No, not at all. Should we also be watching?
It might be.
Yeah, it definitely could be. But should we also be watching the Bank of England, considering they're not giving Venezuela back its gold?
Well, yeah, no doubt about it. No doubt about it. That's another part of the system that's structured the exact same way, like palladium. These banks seem to live hand to mouth, what they're basically trying to do is flow physical metal to meet immediate delivery, and they're living off flow, not stock. You remember the stories, it's been, Patrick, it's now been 5 years ago that guy Ken Hoffman from Bloomberg was talking about how the vaults were empty.
Yeah.
That you used to walk through the London vaults, and see gold stacked floor to ceiling. And now you walk through there, 26 million ounces, it's gone. And everybody went, whoa, wait a second, time out. What? That was 5 years ago. And look how has to have been exacerbated since. Global central banks bought 600 some odd metric tons last year. Biggest amount of gold bought by central banks since 1968. Then you look at India's imports are going to be 700 or almost 800 metric tons this year. We know no gold ever leaves China. All these different things. You wonder, where in the hell is this gold coming from?
Yeah.
There are statistics every single month that get printed about gold leaving the UK exported to Switzerland, then it shows up as a Switzerland import, and then shows up as a Switzerland export to India and China. Well, that gold's not coming back. So again, where's it coming from? So I don't know. Are they so desperate that just a couple of tons from Venezuela would break everything? I have no idea. Maybe.
What should we be telling people who are looking to buy silver and gold with the intention of speculating or trade the price of the metals in the short term?
Oh boy. That's always kind of a slippery slope, because if you start trading, with the way that the price is under the thumb of the banks, you're almost invariably going to do the wrong thing. Because it's like on my site, we have an adage. Whenever things look the rosiest, you got to be prepared to sell some. Don't convince yourself it's going to keep going straight up. And when things look the most awful, you got to be ready to buy some. But that said, most people have forgotten what a bull market in the metals are like. Because we haven't had one for so long. We had a little itty bitty one in 2016. And so people don't really know how to trade that. If that's the case, it's kind of like what's been going on in equities. You got to just buy the dip. You just got to keep averaging in. And I would much prefer people, rather than fiddle around, in the system and leverage and all that kind of stuff, just keep buying physical metal. I mean, just get it, hold it in your hands, hold it, store it safely someplace. Just continue to accumulate. If your average cost, because you bought a bunch in 2011 and 2012, if your average cost of silver is, $35, well then, for God's sake, buy some at 15.
Yeah, average down.
Yeah. I mean, your stockbroker would tell you that. If you bought Apple at 200 and it went to 150, you'd buy some here and average down. And then it's exactly what you do. But everybody else just wants to be bitter and angry and hold on to their silver that they bought at 35. The other thing I'd add, too, that maybe is even more important, Patrick, is what are people going to do when it does get back to 25 or 30 later this year or next?
Great question, yes.
People need to be thinking about that now because, a lot of folks, their knee-jerk reaction is, I'm finally going to sell this crap that I bought 8 years ago. Okay, fine, but why did you buy it 8 years ago, and are those conditions returning? And second of all, what are you going to sell it for? Because as soon as you sell it, you're converting it back into your local fiat currency. Seriously? That's a good idea? Exactly. So people need to kind of mentally, steel themselves, and think about all this stuff ahead of time because that's, like you said, 2010 is going to be a lot like 2019 and or vice versa. And now people need to be thinking about this stuff and kind of preparing accordingly.
Great advice. Craig, how can our listeners find out more about your work?
Well, my site is tfmetalsreport.com. And I got to tell you, I'm extraordinarily proud of the work that we do there and the people that populate it. It's a subscriber-driven, member-driven site. And we have people from all around the world. Almost every time zone as you go around the world. And they all add their own unique experience and perspective. They all add information that they have found over the course of the day. And we recognize we're all in the same boat, trying to navigate our way through it. And I think we offer some pretty good daily perspective on which way price is moving too. So I encourage everybody to check it out. To be a member, it's only $12 a month. So it's not really, like a massive bank breaker. But I think we can, someone who's structuring their physical metal purchases, I think we can save you some money by kind of, like I said, knowing that adage of buying some at the right time and that kind of thing. I think we add a lot of value there and can more than make up the $12 a month fee by saving you money whenever you go to buy physical and buying on a dip. So please encourage, everybody check us out, tfmetalsreport.com.
Absolutely. Craig, do you have plans this year to be in Singapore?
I wish. I wish I was there now. Where I live, it's about 10 degrees outside. So I wish I could.
Well, if you ever do, look us up. But Craig, it was a pleasure.
I will.
Yeah, absolutely. Please do. Craig, it was a pleasure speaking with you and receiving this wealth of knowledge that you have on precious metals. And I do hope to get you on the show again. And thank you for being here today.
Always a pleasure, Patrick. I'd look forward to doing it again.
That was Craig Hemke from TF Metals Report sharing his views on the precious metals market. To find out more about Craig's work, please visit his website, tfmetalsreport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content, and do also check out the SBTV podcast on iTunes and Spotify.